Hello, welcome back. It's our first webinar since last April. Dave, Lauren, good to see you both. And the title of our discussion today is That 70's Show, Not a Rerun. But before we get into any of our planned content for the day, Lauren, let's launch our first poll. I can see that attendees are starting to pile in. We'd love to know, as you all are getting settled, how you're feeling. How are you feeling about financial markets? How are you feeling about the economy? Your financial plan. And we've given you some options: optimistic, neutral, anxious, panicked, or other. And if we've not given you a choice that fits how you're feeling, please do share your assessment of how you're doing. We'd love to know. Seeing a lot of responses coming in, trending towards neutral to anxious. Not too many panicking out there. That's good. We're happy to hear that.
Quite a few anxious.
Understandably.
You know, there's bad stuff happening in the world. Of course, in a sense, there's always bad stuff happening in the world. So,
and yet somehow we managed to persevere. Give it a few more seconds. Still see some responses coming in. Okay, looks like everyone who's here has responded thus far. So I will end the poll. And most of you answered as somewhere between neutral and anxious. So thank you for sharing.
And Vicky, I think that's a good plan. Stay healthy until we get through the other. Of course, as I said, it's always something. So that's a fact of life. We have a chart that we're not going to do it today, but at least I don't think we are. But we sometimes like to look at charts of portfolio returns over the last 10, 15, 20, 25 years and just say, oh yeah, look at this. That was the Greek debt crisis, and that was the fiscal cliff, and that was the taper tantrum, and it just goes on and on. Every year is something.
A great plug for one of the features we did in a recent digest, kind of highlighting all the things that we've all lived through. Check that link out, and we can resend that out maybe along with a recording of today's webinar. Here's our agenda, and if it looks familiar, that's because just about all the items on today's agenda were on the agenda for our last webinar 3 months ago. The news of the day at that time remains the news of the day today. So we'll be providing updates about COVID and its effects on the economy, the war in Ukraine, inflation. Certainly everyone wants to talk about inflation, and relatedly what the Fed is doing with interest rates. And we'll talk about market performance. And although there's been a lot of commentary about how current times feel like the 70's all over again, when it comes to financial markets and how stocks are acting, we see a lot more parallels in line with how things were looking in the 90's and early aughts, but I don't want to give away the punchline too early. Before we continue, we want to launch another poll. Now that we've given you the menu of what we'll be discussing today, we can tailor our comments and emphasize various sections based on interest. So we'd love to know, what are you most interested in hearing about today, based on the topics that we've shared? And you can see those again listed in the poll. Well, from the looks of it, we're going to be able to breeze through the first half of our presentation. Inflation, the Fed, interest rates, and how stocks are behaving right now, taking the strong lead against the rest. Thank you all for submitting your responses. Give it a couple more seconds. All right, well, unsurprisingly, it looks like we're going to be spending the bulk of our time today talking about inflation, and then how the Fed plans to combat it, and then how markets have been doing. And so we'll get there as soon as we can. But let's dive in. And so the quote most often attributed to Mark Twain, whether or not Mark Twain actually said it, is that history doesn't repeat, but it does rhyme. Dave, would love to hear your comments on how the current events or the events of the day kind of feel like a repeat of the 70s. We've got some parallels that we've drawn up on this slide, but let me be quiet and get out of your way and hear what you have to say on this.
Well, as I think it's probably true of some of our attendees, I mean, I was around in the 70s. I was actually old enough to be driving a car. And so I can remember gas prices not only being high, but literally being metered. I mean, it's like if your license plate ended in an odd number or an even number, that determined which days you could even go to a gas station and wait in line for an hour in order to get gas. So while it's true that gas prices were an issue in both decades, it was a much bigger deal back in the 70s. You know, and I don't want to minimize the impact that high gas prices have on people's lives. I mean, people, you know, a lot of people have to drive. A lot of people, you know, that's their life is built around that. And when gas goes from $3 a gallon to $5.50 a gallon, that's a non-trivial, you know, change in their monthly budget. But the global supply shock for oil was much different in the 70s than it is today. And it happened for entirely different reasons. And I think that's, of course, that's going to be one of our themes today is if the same thing happened, did it happen for the same reason? And so often as we will present, the answer is no. So.
Yeah, and you can use that explanation for any of the other parallels. You know, similar as some of the things that we've outlined here may seem on their face, the context for each and every bullet point here is unique, and it's important to keep that perspective in mind as we make our assessments about where we are today and how things are playing out and what we should do in response to the events of the day.
And we did literally have double-digit inflation. I'm not saying 8% that we've seen recently is trivial, but you know, we had 12, 14% inflation back in the 70s and 19% mortgage rates. And you know, you could still get a mortgage today for 5.5% or less. And so it's that's another area where the magnitude is so dramatically different.
Yes, it is. And focusing on how magnitude has changed is a great segue as we shift now and start talking about COVID's continued effects on the economy. What you're seeing here on this chart is weekly rates of hospitalization due to COVID-19. Here we are on the far right. These are the most current numbers, and the lines that you're seeing here are broken out by age group. As we transition into the part of our discussion where we're talking about the COVID economy, one of the things that we've been saying again and again over the past couple of years, this recession that we've come out of was a medical recession, or one that was caused by medical events. And as things continue to improve in that space, we think that that will bode well for economies and markets around the world. Countries are still dealing with COVID-related lockdowns. Of course, China easing things recently, but was locked down as of late in the past few months. Of course, continuing to contribute to supply chain issues around the world. But this chart tells a really encouraging story. As was expected, as the pandemic continued, with the onset of vaccines and with more information, we've been able to reduce the magnitude of the seriousness of contracting COVID. You still get sick, but thank goodness fewer and fewer and fewer people are having to be hospitalized and losing their lives. And the final group of folks who are now able to get the vaccine, children under 5, now eligible. It's a piece of news that hits close to home. Both my kids will be getting their vaccine this weekend. I know Nora, Lauren's daughter, was just recently vaccinated, and that's something that gives all of us reason to celebrate.
And Elise and I attended a wedding like 6 weeks ago, and this wedding was in Texas, and there was an outbreak of COVID. I think most of the attendees of the wedding eventually got it. Elise and I came back to San Francisco and we both contracted COVID for the first time in the last 2 years, for the first time since the pandemic began. And I'm not going to lie, at least for me, it was a kind of a miserable experience. It was kind of an unhappy couple of weeks, but I didn't have to be hospitalized because I am vaxxed and boosted. And so it was not even as bad as the worst case of flu I've had in the past. So so I get to, I'm actually some of these statistics somewhere on that red chart.
Focusing on the economic indicators we've been tracking, if you've been watching these webinars over the past couple of years, you've seen this chart, coming up on maybe 10 times or so. In blue, GDP, total economic output for the US. In orange, the unemployment rate. In purple, claims for unemployment insurance. We'll click 3 times and show you the trend lines, the levels at which each of these indicators were tracking prior to the pandemic. And you can see the recession that was triggered by the pandemic indicated by this gray bar. For the employment numbers, you can look at unemployment in orange or the unemployment insurance claims in purple. We're back to where we were before the pandemic and have been for some time. In terms of economic output, that's just continued to grow and grow and grow. We were at a number closer to 20 trillion in annual economic output prior to the pandemic, closer to 25 trillion by the current measures, which is very encouraging. And just to further set the context, same variables, but looking at a 10-year trend line, there's a lot of talk about a recession coming, and whether or not a recession is coming, we won't know until it's either started or we're out of it, as the case was in 2020. But look at economic output. Over the past 10 years, you can see what the trend was looking like prior to the pandemic, and you can see economic output since. We're well ahead of the trend over the past 10 years. Projections, by the way, for second quarter GDP, 2% annualized. Dave and I were just talking about this prior to starting the webinar. For a developed nation like the US, when you think about average annual growth rate of economic output around 2.5%, it's a healthy figure for a developed nation. And so although that growth rate is maybe a little bit lower than what we've seen in the past year or two, it's important to remember that we needed bigger than normal or bigger than expected for a developed nation, bigger growth rates, because we were digging ourselves out of a pretty big hole, or at least what felt like a pretty big hole. If we zoom out even further, here's COVID right here in the smallest red circle. Here's the financial crisis, and here's the dot-com meltdown in the early 2000s. What we thought was most interesting about this chart is just to make one more point about economic growth, economic stability, economic health. GDP, the US's economic output over the past 50 years has been growing at an increasing rate, despite us surviving, maybe 10 recessions over the past 50 years. And that output has continued to climb, again, at increasing rates, even if we just focus on the past 3 recessions. There's no shortage of bad news out there. To the extent that we can provide,
it's not news. If it isn't bad, it's not news, right?
That's right. So I don't know what you would call this. Maybe some perspective setting, or just a reason to be hopeful on a Wednesday. We thought this was a picture that was worth sharing, and happy to share encouraging news. So that does it on the update on the economy and how things have been progressing. We'll touch next on the war in Ukraine.
I'll just jump in
Please,
there, because there was just a question about the source of the graphs. And a couple of years ago, we subscribed to a database called Y Charts, which is like Yusuf's favorite toy, period, end of story. He's wallowing in Y Charts all day, every day,
daily.
But it's just a source of market data, economic data, inflation rates, interest rates, market rates, and we find it useful. It doesn't necessarily change what we do because we try and base everything we do for clients on really what I like to call like the deep regularities, the stuff that doesn't change day by day. But it doesn't mean that we don't look day by day.
Right.
This is the thing that, Yusuf, Lauren, and I talk about all the time is the fact that we never want to look like we're Pollyanna. We don't want to look like we're blind to the bad things that are going on in the world, but we don't want to base our decisions on the transient bad things. We want to base our decisions and our recommendations on the deep regularities that we can rely on.
You're here. Turning to what's been happening in Ukraine, we're more than 4 or 5 months into this war. The invasion was at the end of February. The humanitarian aspect of this story is of chief importance. Thousands of casualties, millions displaced, and it's really just a tragedy that this is even continuing to be a story. We're gratified to see that the sanctions that were imposed by the U.S. and other nations have been effective. You may have seen the headline recently that the Russians defaulted on their foreign debt for the first time in 100 years. The economy has collapsed. The markets are in shambles in Russia. And civilians are suffering as a result of the choices made by Putin and others in the government and military. The Russians have been focusing on taking control of the eastern end of Ukraine. Most recently overtook the Luhansk region and are now focusing on Donetsk. And those are the keys to controlling the Donbas region, which has been dominating headlines. Why is that so critical? Why is that region of such importance? Access to critical things like mines, factories, land, and positioning. And there's speculation that whomever controls the Donbas region stands the best chance of winning the war. We'll see how things play out. I mean, this has been unfolding unpredictably over the past several months, and we'll see how things go. Hopefully, though, this will end sooner rather than later. That's the thing that we are focusing our hopes on. In terms of how the war affects markets and the economy, we'll talk about oil first. That was one of the chief stories that dominated headlines when the war began. Setting some context, so Russia is the third largest producer of oil in the world. And as of 2020, oil and gas made up 60% of Russia's exports and 40% of its federal budget. China and India have stepped in as two of the largest consumers of Russian oil. Now that there have been embargoes placed, Europe is moving away from buying oil from Russia and so on. Interesting to note, oil prices may have peaked a few weeks ago. They were up at about $122 a barrel. Now in bear market territory, oil is trading at less than $100 a barrel as of this morning. That's important because, again, Russia makes so much of its money as a nation by exporting oil. If prices go down, the money that Russia makes off producing and selling that oil also goes down. And so right now, Russia's financial prospects have taken a significant hit. And to the extent that that plays into its ability to continue funding the war effort, we'll see how that plays out. In terms of natural gas prices were already going up primarily in Europe. Not so the case in the U.S. We produce a lot of natural gas domestically. And then the war started, and that exacerbated the shortfall. So prices are skyrocketing in the U.S. and Asia. We're showing you in the chart here on the right consumers of natural gas countries and the percentage that they consume per year. Right now, dominating the headlines is the risk posed to Germany because of these higher prices. And so countries around the world are banding together trying to increase supply. Doing so is a bit counter to long-term environmental goals, and so we'll see how that's ultimately reconciled after the fact. But right now, what countries are trying to solve is just a supply problem, making sure that nations around the world have the sources of energy they need to get through the rest of the year and the coming years. And here showing you just the magnitude of the price increases in Asia in pink, in Europe in black, and you can see the spikes. US natural gas prices, as we just said, not jumping up quite yet. This is yet another thing that we'll continue to follow as the weeks and months go by, but making sure that we had a bit of an update here is a relevant part of our discussion on the war. And so, again, we mentioned the humanitarian aspect as obviously the major point of significance when thinking about this war. As we look at the financial and economic ramifications, we had these 3 bullets in our last webinar, more as observations that we expected to unfold. We expected prices to be higher for commodities. We expected there to be supply chain disruptions as a result of the war, and we expected markets to suffer as a result of reduced confidence in the face of uncertainty. And we've seen all those things play out just as expected. And again, we hope that this war comes to an end sooner rather than later. Certainly that'll mean good things for markets and the economy. Again, most importantly, that'll mean good things for the people of Russia, the people of Ukraine, and the world at large.
Right. I mean, I know, while there's been some movement to try and move, I mean, Ukraine is a huge supplier of grains and oils based on grains. And there's been some move to try and transport some of that by rail to Western Europe. Historically, most of it has left via ships, via Odessa and other southern ports. So human beings are resilient and ingenious and problem solving, and some of those blockages are going to be they're going to be resolved, but we're not there yet.
Soon. All right, we've come to it. Inflation. And so, Dave, you were talking about this earlier on in the discussion. We're gonna bring the comments back to how what we're seeing today in terms of inflation and how the Fed is combating it just isn't like what we were seeing in the 70s. We'll click here to remind you that the inflation rate depicted here, the federal funds rate depicted here on this chart by the orange line was increased to 20% to bring inflation down at the end of the 70s and beginning of the 80s. 20%. And that's not to make light of the situation we're in now, but 75 basis point increase, or 0.75%, or raising rates right now, the federal funds rate is somewhere between 1.5% and 1.75%. Bringing it up to 3% just isn't the same as talking about an increase up to 20% to combat inflation. And there's that line for the current federal funds rate. Inflation's high right now. It's not at 14% as it was, some 50 years ago. And so again, just setting perspective, setting context, and noting that, the spikes that we saw in inflation some 50 years ago were for reasons completely different from the reasons that we're dealing with inflation today. So much of what we're dealing with today can be explained by the supply chain disruptions that we've been dealing with and still dealing with as a result of COVID. And now, because of the war in Ukraine, further complications in the global supply chain. That has more to do with inflation than anything else. And so the response to dealing with that rate, the inflation rate, simply hasn't had to be the same as it was back then.
And something
before I move on.
Yeah, I was going to say something we like to point out whenever we show a chart like this. The gray areas represent recessions. And if you look at the orange line, the federal funds rate, you'll see that pretty much every time the Fed funds rate goes up, it's followed by a recession. Now, that's not me predicting a recession, by the way, as the Fed is beginning to raise interest rates again. But it's more, basically, it's more saying Jay Powell and the rest of the Board of Governors are being cautious for a reason, because they look at these same charts and they go, well, historically, and there was an article in the Journal last week that said, I think the so-called soft landing was a myth, that 17 out of the last 19 times that the Fed raised interest rates, it was followed by a recession, which is not considered a soft landing. And Jay Powell is aware of that. The Fed governors are aware of that, and that's why they're being so cautious, because they look at a chart like this and they're like, well, we could spike in interest rates. We could spike the Fed funds rate the way Paul Volcker did back in 1982 and be guaranteed of having a recession. And we would also knock the inflation rate down. But today's Fed is saying, let's see if we can navigate a path through the middle. Let's see if we can moderate inflation and not send the economy into a recession. So it's an interesting experiment that we're all living through, and I can't wait to see how it works out. I'm optimistic. At least I'm cautiously optimistic.
Well, there are reasons to be optimistic, Dave. So, if we just look at, this chart is showing you 3 different inflation rates that we've been tracking over the past few years. In purple is that headline CPI, Consumer Price Index, that you hear about on the news, 8.5% as of the most recent reading in June. We'll get another number, a fresh number here this time next week. You can see that number's been climbing. Interesting to note that when you start breaking down the components of the inflation rate, focus on core inflation, that's here on in the orange line here, you pull out food and you pull out energy prices. Again, the 2 items that have been most dramatically affected by the war in Ukraine and are generally the most volatile components of the inflation number. You pull those out and you see how much lower the core inflation reading is down here at 6%. Even more interesting is the widening spread between, again, headline inflation here in purple. You can see a year ago what the spread was between the CPI and core CPI. And you can see how much wider that spread is as of the most recent reading. And so that's reason to be encouraged. If the things that are continuing to drive higher prices are easily explained and traced back to the war in Ukraine, and one would hope that as soon as there's a solution there, we'll start to see things calm down with the headline rate. And we may see things calm down anyhow. Recall that we already mentioned that oil prices are down some 20% in recent weeks. That's going to help with this figure. And how things play out with respect to food prices and so on, only time will tell. But if the rest of the components of the inflation story continue to be trending downward, that's good news. Different visual to add a bit more meat to the story on inflation. This chart comes from the Washington Post. They've been updating this chart monthly as the inflation readings have been published, just showing the various components that make up, the different that make up various proportions of the inflation number. And so you can see, shortly after the invasion in late February, energy prices spiked, oil prices were up, and look at that, taking up a huge share of the increase in prices for that reading. Bounced back into the story here in the most recent reading. We'll see what happens when we get next week's numbers. And it's interesting to see how some other items have come in and out. You'll recall last year, used cars and trucks were dominating headlines for huge prices. They kind of fell off the page here a bit. Travel has been getting a lot of news lately. Folks are out there traveling, moving about, getting back to their business. I think airlines are seeing traffic similar to what they were seeing in 2019 prior to the pandemic, which is good news for everyone. And so you can see airfares with some higher prices making up a bigger portion of the inflation story. We'll see. As things go, it's expected that shelter will take up less space. Rates go up, interest rates go up. Prices should start to come down, and so hopefully that will contribute to lower prices as we go forward.
Read an article yesterday that said that the that residential rents in San Francisco are down significantly from where they were pre-pandemic. In part because a lot of, San Francisco had a very high proportion of tech workers, and a lot of the tech workers, they moved away. They're working remotely
from
now.
Anywhere.
And
right.
So you're right, exactly. And so the demand for rental real estate has gone down. and it's reflected in much lower prices. I mean, significantly lower than they were 3 years ago.
Speaking of lower prices, this chart tracks gas prices through May. Of course, we've been talking about how oil prices have come down in recent weeks. We'll be very interested to see what this chart looks like in a few weeks' time. Prices for gas are down below, so the national average is now at $4.80. It was in excess of $5 in recent weeks and months. So encouraging news on that front. And we'll hope that the trend continues downward. That's relief for everyone. Cheaper gas is always a good thing. And likewise, food, just showing you a breakdown of how various, different types of food and the increases that we've been seeing over the past year or so. Of course, wheat coming out of Ukraine, and then the disruption in that supply, of course, feeding into higher prices around the world. Of course, the animals that eat wheat, any food prices related to meat, poultry, and so on, of course, directly affected by higher wheat prices as well. And so just things that we'll continue to keep an eye on as the weeks and months go by, and we'll continue to report on and share our take. And if you think that inflation is an issue just in the US, we're showing you some of the top 15, 20 economies around the world ranked by size, economic output here on the far left. Higher inflation rates kind of across the board. United States up here, the projection for the average inflation for the year, just under 8%. And you can see the figures down below for countries around the world. Everyone's dealing with it. And in response to higher inflation
Wait
rates,
a minute, you're saying it's not all Joe Biden's fault?
As it's been said, no one man has all that power, and so we have to take things in context. Countries around the world are also raising their interest rates to combat inflation. On average, we're seeing rates going up between 50 basis points and 100 basis points, or 0.5% and 1%. In some countries, those numbers are dramatically higher, but this is something that we as a people around the globe are dealing with, and dealing with in roughly the same way, using the tools that we have available to us, trying to be creative and showing our resilience as we continue to try to deal with this inflation monster. And so that segues into what the Fed is up to. And again, we've shown you this chart. We bring it up again, just to note that the rate increases that we've been seeing as of late, while they've been, getting a lot of ink in headlines, it's really not as dramatic as what we've seen in prior instances where the inflation rate has been higher, where the Fed has had to manipulate, the baseline and interest rate, the federal funds rate. And we just want to continue to remind folks and provide that context, because the media is not trying to help you feel better at night. The media is trying to get you to click. And so as we click through to the next slide here, just a reminder that when the Fed raises rates or decreases rates for that matter, there's a window, a target range. So, you might see some variance in the numbers when you're looking at, well, what is the federal funds rate right now? The target range is somewhere between 1.5% and 1.75%. And so when the Fed meets next and determines how it is going to increase, whether it's going to increase rates again and by how much, right now the expectation is an increase of another 75 basis points, or 0.75%. So that'll take the range up to somewhere between 2.25 and 2.5%. So just a reminder there about how that works. And then talking a bit about what to expect from the Fed. So not shown here is how things played out last month. So the inflation reading was just published on June 10th. And the Fed met some 4 or 5 days later. The numbers came in higher than expected. Folks were expecting the inflation rate to have come down. It actually went up slightly from the past reading. And at that point, the Fed then responded and said, okay, rather than what was expected, 50 basis point or 0.5% increase, Chairman Powell went ahead with a 75 basis point increase, and markets reacted negatively to that. They were a bit caught off guard. It'll be interesting to see how the Fed digests the inflation reading, again, due out a week from today, this time with 2 weeks to digest the information, and 2 weeks to see how markets respond, how investors respond. I mean, the Fed has to walk a fine line, as you were just saying, Dave, and is maneuvering this not only economically, but politically, and trying to make sure that they're not doing things that contribute or detract, rather, I should say, detract from consumer sentiment.
And that's been an example of how how this Fed is being cautious but not doctrinaire. They're, you know, they're prepared to increase the rate at which they raise rates if it seems like the evidence is supporting that. And I think they will likewise decrease the rate at which they raise rates if the evidence supports that as well. So the next inflation reading is going to be really pivotal, I think, for the Fed. And it's and I think it's quite possible if we actually see a downtick, I could see them dropping it to 0.5%. I mean, they were originally saying they were going to be moving at 0.25% increments, and they moved away from that because inflation did stay stubbornly high. So we'll see. Right. But they're not doctrinaire. They're very much looking at the evidence.
Fingers crossed for a lower reading, and then we'll be holding our breath for a couple of weeks to see what the next rate hike is. And then that will, of course, inform what comes out of future meetings. The Fed will take the rest of the summer off in terms of getting together for meetings, the next meeting being in the latter part of September. The expectation at this point is another rate hike at that point, but we'll have 3 or 4 more readings of the inflation figures by then, and no one knows where we'll be at that point, but we can only hope that things will be better. So what does it all mean for stocks? What does it all mean for markets? What does it all mean for our clients' portfolios? As we said earlier, it might look like the 70's, but it actually has been feeling a lot more like the 90's and early aughts in terms of how the portfolio has been performing. So we'll take a look. In purple is the stock portion of the Yeske Bui portfolio. So you can see that year to date, our portfolio down 16% when compared against the All Country World Index, which is a global index in blue. We're outperforming that benchmark by nearly 4 full percentage points. Gratified to be able to report that. And interesting to note that international stocks measured by the orange line here, that's the All Country World Index ex-US, or not including US. International stocks have been outperforming US stocks, and so you're seeing that reading come in a bit higher than the global index just below it. That's not necessarily the prediction people were making after the Russian invasion of Ukraine. Folks were saying international stocks are going to tank. It's bad news, and yet, as we say so often around here, the market doesn't really care what you think. And so we've seen how things have played out, maybe to the surprise of some. We should also note that, of course, we carry bonds and cash in our clients' portfolios. And so when you factor in the performance of bonds and cash, year to date, our aggregate portfolio is down about 12%. And so we've been, again, gratified to be able to report outperformance relative to our benchmarks, and hoping for things to turn around as soon as they can. But happy that there's been some downside protection provided up by our portfolio for our clients.
I did see there was a question about putting $10,000 in I bonds, and actually, we think I bonds are great. The biggest problem with them is that you can only put $10,000 in them. Right. But the rates have been really quite impressive, and so I mean, it's I haven't done it myself. I probably should, just so I can experience it. But everything I'm reading suggests that the Treasury, the Treasury interface for buying I bonds is pretty kludgy. That it's a pain in the butt to go through the process. But with the rates being that attractive, I mean, there's no reason not to. Again, it's just that you're capped at $10,000, unfortunately,
per person. So a couple can go out and get 10,000 each, 20,000. But yeah, unfortunately, still capped there. Here on this chart, it looks similar, but we're tracking different information. The Yeske Buoy portfolio in purple, the S&P 500 in orange, so again, down about 20%. The NASDAQ in blue, down nearly 30% year to date through the end of June. And so again, if you'll recall how things were looking and feeling, back in the late 90s and early 2000s, tech stocks were the culprit and the reason why we were seeing such dramatic declines in the S&P, with tech stocks were taking up a big portion of the S&P at that time. Of course, the NASDAQ focuses on tech stocks. And we're seeing that kind of activity again. And on the heels of really huge growth numbers over the past, 5 some odd years in those areas. And again, that's just like what we saw in the 90s. So interesting to see how history is repeating. What we'll note is the reason that our portfolio has been performing better than the benchmarks has everything to do with our tilt towards value stocks. Quick refresher, value stocks are the stocks of companies that are trading at prices that are lower relative to their more expensive counterparts. So if you have two companies that are identical in just about every form, but one is trading at a lower price relative to the other, the cheaper one is the value stock. And so we tilt our portfolio in favor of those companies trading at relatively lower prices. And those companies tend to do better in instances when interest rates are going up. And so what we're showing you on this chart is the difference between the index fund that we're using in these 4 different quadrants of the portfolio: domestic small, international small, domestic large, and international large. In each of those quadrants, we have an index fund, and then we have a fund that focuses more on value stocks. The difference in performance between the value stock fund and the index fund is indicated by each of these bars. So U.S. small value outperforming U.S. small, the broader index, by nearly 5% year to date. Same story on the international small side. And then with the larger companies, the outperformance even more pronounced. International large companies outperforming their more expensive counterparts by nearly 9% year to date. And so gratified to see what is described as the value premium, a premium that we seek to capitalize on, one of those deep regularities, Dave, that you were alluding to earlier. Gratified to see that working as it should, as expected. So we had a slide earlier in the presentation with the same title, but now we're focusing more on how what we're seeing presently really is tracking with what we saw in the late 90s and early aughts. Interest rates on the rise, and after a protracted period of dominance, the same asset class, U.S. large company stocks, are now among the worst performing. And this is why we diversify. We owned U.S. large company stocks they were in the portfolio when they were beating everything else. They're still in the portfolio, but we owned small and international stocks when U.S. large companies were dominating, and we own them now as well. And we're seeing the benefits of being diversified. Those are coming to the fore now that we're seeing that there's a change in leadership amongst different asset classes in the portfolio. And just as we saw some 20 years ago, value stocks were powering the portfolio's outperformance, and they're doing so again. We showed you the value premium chart from this year on the prior slide. Here's what it looked like in 2000. And so, different decade, same story. In fact, the value premium, you can see the axis here on the far left, going all the way up to 20%. So U.S. large value companies some 20 years ago dominating their more expensive counterparts. And if you had a chance to read our feature in the digest a week or so ago, we pointed out that in 2000, the benchmark was down by double digits. Our portfolio was up by double digits, a disparity of more than 20%. And that had everything to do in that instance with the tilt that our portfolio had towards those value stocks, which are supposed to perform better in circumstances like this. So again, just gratified to see the portfolio doing what it's supposed to be doing. And for the phenomena that we've been observing over decades persisting. And it's those phenomena that drive those deep regularities that are they serve as the rationale behind the portfolio that we've built, the one that we think is a portfolio for all seasons, an all-weather portfolio, one that's well-positioned for this economic climate, or really anything that markets are going to throw at us, in the coming days, weeks, months, and years. We continue to think that it makes sense to be globally diversified. We continue to think that it makes sense to be tilted towards value stocks and small company stocks, by the way, which we hope to see return to dominating the larger stocks. And because we keep a relatively high allocation to stocks, in our portfolio, it's a higher growth potential. And having a higher growth potential is a great response to higher prices. If you're outpacing inflation, that's real growth in your portfolio, and it keeps your purchasing power intact, if not growing it over time.
But if you're retired, sorry, I was just to say, but if you're retired, we have 6 to 7 years worth of cash and bonds, right, as a stable reserve to bridge you through any downturn in the stock market, because we can't predict what's going to happen in the stock market or the economy at large. So instead, we try and build resilience into the portfolio. And we think 6 to 7 years
is a lot of resilience.
Yeah, exactly.
You can tell we spend a lot of time talking about this.
Oh, yeah. Every day.
That brings us to our final prepared slide here. I'll take it to the next slide and pause. I know that we've gotten some questions throughout that we've answered, but Lauren, what's up next?
So we have one here that is actually a perfect lead-in question to something that we already have done, but what do you think of harvesting losses in bonds for tax purposes?
I think it's a great idea. That's why we did it a few months ago. We identified an opportunity and were able to capitalize on it. So harvested some losses earlier in the year. Hopefully those will come in handy to offset some gains down the line, but we went ahead and locked those in and took care of that.
Wonderful. And we had a request, Dave, to see Elisa. She's not in the office right now. She's enjoying herself. I don't think she would want to be here, but she says hello, I'm sure.
Yes, she was. Yeah, she's up in Healdsburg right now, enjoying the country life with our dogs, but we'll make sure she's on the next webinar.
Smart lady. Make the men shoulder the workload. That's what.
There you go. There you go.
We did have a question here on losses. Can both long-term and short-term losses be carried over to future years? And the answer is yes, they can be. That's my 15 seconds of fame.
Well, so yeah, because for anyone who doesn't know, Lauren has a graduate degree in taxation, so she is one of our subject area experts when it comes to anything tax related. But the thing I'll note about the bonds is that the bonds performed as we expected. As interest rates went up, the bonds, they did go down, but they didn't go down by very much relative to what's happening in the stock market. So it's not when you buy bonds, it's not like buying a CD. You don't have a flat guaranteed value. There is the possibility of modest loss. And that's what we experienced. So the losses we were harvesting in bonds, it was an opportunity to seek a tax benefit, but they weren't huge losses. I mean, I just think that's one of the things that's important to note, is that the bonds are a relatively stable source of value, but not perfectly stable. And so we did a little fine tuning.
So one more question come in. Where should people place extra cash right now?
Ends, right? Your classic financial planner answer. If you need it for, a short-term need somewhere in the next year, 18 months, keep it in cash. If you don't, I don't know, Dave, don't you think it's a great time to buy?
You know what? If this is right, if this is extra cash that, as you say, can be committed long-term, I'd go into the stock market without hesitation. We've sent most of you, probably all of you, a book called The Investment Answer at one time or another. And there's a line in that book that basically says the best time to put money in the stock market is when you have extra money. And the best time to take money out of the stock market is when you need it to spend. So if you have extra money, it's always a good time to put it in the stock market. Not because we're predicting that it's going to go up tomorrow. It's just that if it's excess savings, that's, in the long run, that's the best place to put it.
Yeah, and you're buying in at prices that are 15, 20% lower than they were at the top of the year, and we expect markets to make a full recovery and then set new highs. And so there's lots of value that you can capitalize on.
It's like each, those charts that Yusuf prepared, just are always an attempt to give you a wider frame, to say whatever's happening today, this week, this month, needs to be viewed in the context of this year, this decade, whatever. It's like we all saw the headlines at the beginning of the week that said, essentially, S&P 500 has its worst half year since 1970. And as I was saying to Yusuf, I immediately tweeted something, which means it was kind of pointless because, right, Twitter's not serious. But I immediately tweeted out that headline, followed by the line, but here's what you really need to know. The price level of the S&P 500 in 1970 was 74. And the price level today is 3,800. And even adjusted for inflation, even after inflation, the real rate of return on average was basically about 4% between then and now, which is what we assume when we're doing our long-term projections. So, it's having a bad year, but in the long run, that's where you want it to be.
And the only reason that it's the worst since 1970 is because things cratered in the first part of 2020, but rebounded so quickly. It didn't fit the stat for the first half of the year.
Yeah, 2020 was kind of an amazing year, and obviously we had charts that were showing it, but it's like it was one of the biggest declines we've ever seen over a very brief period of time, and it was one of the biggest recoveries we've ever seen over a very brief period of time. Who would have thought in the middle of March or the end of March that we would end the year up, net up, pretty dramatically? I mean, This is why we try and make plans that don't require us to be able to predict what's going to happen in the short run. But we do know what's going to happen in the long run. If you ask me, is the market going to go up or down? I'm going to say up. Just don't ask me over what time period. But over the long run, definitely, because it just represents ownership of the productive assets of the economy. And so, what else would you want to own?
We did have one other comment here that I think could have a good story to it, or how we think about things about the allocations to stocks and bonds, especially for clients spending from their portfolio. Most of our spending clients are at 70% stocks, 30% bonds, and there is an intentionality behind that. But the comment here was, I'm intrigued with the idea that even at my advanced age, which isn't advanced, that preferred balance between stocks and bonds still tilts towards stocks. That goes to my preferred outlook on life, which is to suggest that I'm here for a while.
I love that. Boy, enough said. What a great sentiment.
And just one comment that I did answer in, I had responded back in the chat, but how the Social Security cost of living adjustment is created or is determined is the CPIW, which is the CPI for urban workers and clerical workers. And there is a calculation. I'll copy and paste it here if anyone's interested. Fred found it for me online. If anyone's interested how they actually calculate that cost of living adjustment or the COLA. So I posted that.
That's great. Thank you, Lauren.
All right, we have one more question that just came in. Knowing that you don't make predictions, what is your guess right now about when the market might recover? Should we go to Vegas?
I mean, Dave, call me on this, but you know, when inflation comes down and the war in Ukraine is over, those would be two pretty positive indicators. So we'll be watching those and seeing how things turn around from there.
That was exactly where I was going to go. It's when there's new news, when something changes. And those are the two, those have been two big factors that have been depressing the market. And so when those flip, those would be two big factors that I think will raise it up again. And I think what we're going to find, the market represents a wisdom of crowds, right? There's a lot of information that's being digested by the market. Typically what you find is the market rises before things become official. So if we see the market going up, we could probably anticipate that we're going to see inflation going down and maybe even seeing some resolution to the war in Ukraine. But the market tends to anticipate things because it's a big human organism for processing information, and it tends to do a really good job. We seem to be arriving at the top of the hour. And then Lauren, unless we have more questions, I think that we'll just thank you all for joining us. This has been recorded. You'll be sent a link. If you want to share it with friends, family, colleagues, please do so. And if you have follow-up questions, email us or call us.
Thanks for being here.